Inflation heats up to the highest level since 1982. Welcome to today's mortgage market update for February 10th, 2022. Mortgage bonds are hiking to, mortgage bonds are likely to anticipate the Consumer Price Index report has come out this morning. And the index measures inflation on the consumer's level, and it rose by 6 tenths in the month of January, which is higher than expected. And the year over year rating on the CPI went from 7 to 7.5%. Now, this is the highest rating in 40 years since 1982. Now, the core rating of the CPI, this strips out food and energy, also rose by 6 tenths of a percent, which was also hotter than expectations. And on a year-over-year basis, it rose from 5.4% to 6%. Again, can you imagine highest inflation we've had in 40 years since 1982? Now, we do believe we are getting close to reaching peak inflation. You see, next month we should hit the apex in inflation. When we get February's inflation numbers, which will come out in March, they will be replacing year over year numbers that are very similar to it. And when that happens, our inflation should stay the same. It could go higher slightly depending on where those numbers come in, or it could even possibly pull back over time depending on those numbers. So we're just going to have to wait and see where the monthly inflation comes in to see what it does to the year over year inflation. Um, so we could see inflation come down, and especially we could possibly see it just depending on what the Fed does when they hopefully step in to raise the Fed funds rate in March. So speaking of the Fed futures are showing a 54% chance that the Fed it could hike rates not just by a quarter of a percent, but by a half of a percent in March. Now, a lot of people don't know what the Fed funds are. And when they hear that the Fed's hiking rates, they all of a sudden think the rates are on everything are just going up. But Fed funds are short-term interest rates in which one bank lends money to another bank overnight. Now, it does affect things like your home equity loans, your short-term rates, if you have an adjustable rate on a mortgage or a home equity loan or line of credit, you could see your interest rates on those types of things change because they could be tied to the Fed funds. But your fixed rate mortgages, it does not affect those at all. And when we see the Fed funds, we still feel that the Fed will hike them by probably just a quarter of a percent. We don't feel that they're going to go the full half of a percent in an effort to ease back into the hiking of it. There are some Fed members that would like to go the full half percent, and there are some Fed members that would like to sell some mortgage-backed securities during the runoff period. Now, runoff is when the mortgages that are on the books at the Fed are being paid off. So they're being refinanced, the people are selling houses, or maybe they're just paying off their mortgages. Right now, the government is taking that money and they're reinvesting it back into mortgages. And they're doing this at the tune of $100 billion last month alone. So some people don't want, you don't want the government doing that at the same time they're raising rates. It could send our market into chaos. But why is this so important? And it's because when the Fed hikes rates, it curbs inflation. And long-term rates, like mortgage rates, will respond by actually moving lower. So it's a good thing for us. But when the Fed reduces their balance sheet, like they sell off mortgage-backed securities or they let the runoff happen, that's actually a bad thing for mortgage rates. So we'll have to see what the Fed does when they walk this tightrope to curb inflation without upsetting the stock market. Now, if you haven't watched my 2022 mortgage forecast video, I highly recommend you go back and watch it. And you can actually do that by going to our YouTube page. So if you go out to YouTube, and right there you can see it, just look for Rebecca Foot Mortgage Team. Make sure you subscribe. But you can see all of our videos on here, but you see all of our mortgage market updates. Just scroll over, and right here is the 2022 forecast. It's about 15 minutes long, but it really explains what has happened in the past, with inflation, when inflation has rose, what our Fed chairs in the past have done, and how that has affected us, and what's probably going to happen this year. And another thing I want to show you is these are mortgage-backed securities and where the bonds are trading. And you can see, look at this. This is from January all the way to now. And you can see that our mortgage bonds have taken a huge hit this year in 2022. Mortgage bonds have gotten worse, which means your interest rates have gotten worse. It's something that we knew was coming. This is not a surprise to us whatsoever. We told you this was happening. So that's why I want you to watch the forecast, because there is light at the end of the tunnel. When the Fed buys or raises these Fed funds rates, they curb inflation, it's going to help our interest rates. So over time, it's going to be towards the end of the year, these rates will come back down. But in the meantime, they are going to go up a little bit. You are pushing towards 4% with these rates on the 30-year fix now. It has to do also with your credit and the type of loan you're getting, but it is going higher right now. It's unfortunately it's just how it is, but it is still a really good time to buy. You know, appreciation is still happening. We should be in a high single digits this year. So you don't want to wait to buy. You're just going to end up paying higher for a house. We can always refinance you later when interest rates drop if it's in the best interest of you and your situation. If you have any questions, please reach out to the Rebecca Foot Mortgage team. We are here to help you. Have a great day.